Stablecoins are designed to track an underlying currency. The most common example of this is US dollar stablecoins, where one USDC, for example, should always be worth $1 US. This allows market participants to hold their funds in low volatility assets which don't go up and down as much as Bitcoin and Ethereum, but then still participate in DeFi and yield farming to gain high returns on their investment. In this video, I'm going to talk about 3 different high-yielding stablecoin strategies and how I moved the stablecoin part of my portfolio around to get the best returns throughout the year. My name is James Bacchini. On this channel, I create content about digital assets and decentralized finance. If you're interested in learning more about blockchain and consider subscribing to the channel, please note I'm not a financial advisor and this is not financial advice. So the first project I'm going to talk about is Solidly. Solidly is a new automated market maker or a decentralized exchange which was built by Andre Cronje, one of my favorite people in the space. This was launched in January and the rewards have just gone live in the last couple of weeks. For me, I think the best opportunity here is rather than investing directly in Solidly and providing liquidity in their liquidity pools, I think Solidex Finance offers better risk to reward. So if we connect the wallet and go into this. So Solidex is a yield optimizer for Solidly. We're connected, let's go and have a look at the pools. You can see we've got a couple of US dollar stablecoins here, USDC MIM and USDC Frax. Both are kind of ranging at the moment between 15 and 20%. When this first went live, they were over 50% APRs. For me, the big risk factor here is that Solidly is a new exchange. It's quite innovative and there's quite a lot of new code. That means that there's the potential for smart contract bugs and smart contract failure leading to loss of funds. That's still quite low probability. I'm not saying it is going to happen, but it's something to factor in when you're discounting these APRs. Currently, Solidly is only deployed on the Phantom mainnet, and that means we need to transfer funds using a cross-chain bridge like multi-chain to transfer funds from Polygon or Ethereum into Phantom so then we can then use them either directly on Solidly or on Solidex Finance to earn rewards. The next project I want to talk about is Anchor Protocol on the Terra Luna ecosystem. And for as long as I can remember, this project has been providing just under 20% APY. That return doesn't fluctuate very much. And if you want a strategy where you're not moving funds around all the time to kind of look for the best opportunities, this could be quite attractive. Returns of over 19% annually are very competitive for the market. And this is for holding UST, which is the native US dollar stablecoin for the Terra ecosystem. The big risk here, I think, rather than smart contract risk, is probably regulatory risk. And Do Kwon and the Terra team have had a legal fight with the SEC in America for some time now, and I think that's starting to heat up and it could potentially impact that ecosystem. There have been questions raised about whether UST and this high return is sustainable for the long term. With that being said, there's a lot of funds locked in Anchor Protocol. The total value locked is over $13 billion with a yield reserve of $478 million, which means that there is some barrier if we see a long-term market decline. The next strategy that I want to talk about isn't a particular protocol or yield farm, but it's rather moving funds around on a regular basis or an opportunistic basis to gain the best APRs throughout the year. For this, we can use something like MultiFarm Finance, where we can set up advanced searches for, you can look at stablecoin pools, apply that. You can see here we've got a list of stablecoins and their returns. If we went into the Phantom ecosystem now, one interesting thing is that the USDC Frax is currently returning about the same percent as the Solidex exchange. So if you want to have your funds in Spirit Swap and liquidity provider fees in the same stablecoins that you're providing rather than in governance tokens, and that might be a good option, particularly if you're not particularly bullish on the Solidly exchange. As you can see here, there's loads of different opportunities across different blockchains. And some of this, like, you're going to get hit by transfer fees when cross-chain transfers, when you're moving funds around. So the rewards of the pool that you're moving to need to make up for that. I think the best thing to do is look at pools which have some longevity so that it's not going to be something that kind of you move your funds in and then the rate drops down almost immediately. It needs to kind of pay for that hassle of moving the funds around and the extra risk you're taking in not only moving funds but holding it in a new protocol. The general idea here is that you want to put your funds or your stable coins into the highest expected value pools. You want to get the best risk to reward for your assets. The final thing that I really like to keep an eye on is DeFi Llama. This provides a list of protocols and blockchains by TVL. If you see a real spike in the TVL for a certain protocol, it normally means that something's going on there. Well, you might be a little bit late. It probably means that there is an opportunity there, and money is flowing into that opportunity to try and maximize rewards. And it's worth looking at and investigating further. The final thing I want to talk about is diversification. This means not keeping all your assets in a single place. And there's a famous saying in traditional finance where diversification is the only free lunch. I think this is really important for yield farming stablecoins, because if we have all our funds in a single protocol, then if there's a smart contract bug or a loss of funds, then our risk of ruin is really high. By splitting our assets up into maybe 3 to 5 different strategies, and then a constant interval or a regular interval, or even on an opportunistic basis, kind of taking out the lowest performing strategy and moving those funds to a new strategy and kind of optimizing it that way, we can align our portfolio with the best opportunities throughout the investment period. We're reducing our risk of ruin by having a catastrophic loss of funds in the event of something really bad going wrong. In the past, I've mixed this in with kind of delta neutral strategies as well. Something like a basis trade where you're buying Bitcoin on spot markets and selling one Bitcoin futures contract, so that you're still pegged to the US dollar, because if Bitcoin goes up or down, you've got a balanced portfolio, be collecting the funding rate premium. That's not as good currently because there's not as much demand for leverage in the current market conditions. But when things pick up, that's likely going to come back and it'll play a big part in my portfolio as well. There's so much opportunity in DeFi that all you have to really do is stick around and not do anything too stupid. I think for most people, there's an opportunity to have a small percentage of their portfolio in stable coins which are earning yield. In traditional markets, if you can earn 7% a year, which is kind of equal to the S&P 500, you're doing really well. There's the potential to exceed that without taking on huge amounts of risk here. And I think that's a really compelling use case for digital assets. I hope you found this video interesting. There's more information linked to in the blog post in the description. Please consider subscribing to the channel if you want to learn more about blockchain technology, and hit the like button for YouTube algorithm. Thanks for watching.